To kick things off, just taking a step back here, why is it so important for traders to stay in tune with the market and kind of what where we are in the overall market cycle, whether that's uptrend, downtrend, late uptrend, start or beginning of a correction? Why is it important to stay in tune with what's going on?
So you're saying even while you're in a correction and when maybe you think you should take a vacation.
Yeah, yeah, exactly.
Yeah, because that's the time where you really got to roll up your sleeves and do the work and find out what's holding up well, what maybe those next leading groups will be. And as I'm about to show you in just a second, that's where you're going to get the potential leverage going forward. So this is when I actually spend the most time really digging in and really doing a lot of screening and trying to find the stocks that are some of the better performers during the correction.
Yeah, perfect. And I asked people on Twitter what they'd most like to ask you here, and I know you pay a lot of attention to how stocks are performing, how many setups there are, but they were curious if you use any other market indicators that help inform you about the overall health, whether it's breadth metrics, trend indicators, stuff like that. So anything like that you take a look at?
So I'm always trying to gauge the participation as to how much participation there is for, as you mentioned, breadth. So that's how strong the market is, how much of an engine, is beneath the surface, and also, where that participation is coming from. So this is a good segue right into a few slides that if you've been following me on Twitter, you've seen I've been talking about this stuff for quite a while. But if you go back to back to the correction before we had this correction, of course, had a sell signal. I gave a sell signal on November, I guess it was 22nd, 2021. And a large part of that was because of the divergence. Here is the percentage of stocks above their 200-day moving average, and this is the NASDAQ composite. So beneath the surface, and this is something that we just saw happen just recently, where you got this big glaring divergence. And in my 40 years, I've never seen the market survive when you get this scenario without at least a correction. And that's when you get below the 50% number,
Hmm.
particularly in the 30s. That's where if you get down in the 30s where you're hitting new highs or you're diverging for a period of time, usually you have to have a correction, or if you've been going up for a long time in a bull market, you'll usually enter into a bear market. And you can see right here, as we're hitting new highs, we're well below and we're way above the 200-day moving average. And more recently, you can see we ran up here off the lows. We had a really nice run here. And then you're getting that divergence. You're below the 50% mark. And then even when you're well above this level, you're starting to improve, and it looks like, okay, maybe we're improving here. We get above that 50%, we correct here, and now we come down into the 30s. So if this market, as it's rallying back, it gets back into new high ground, you're just going to diverge even more. So you could pretty much see that the participation is getting weaker and weaker. And now, as you come back up to those levels, you see you're in the 30s now, and that's what led to this pullback, where now we're going to get the indexes to pull back probably near the 200-day and agree more with these stocks that are, the grand majority of them are already below the 200-day moving average. Just something that I tweeted about, and also the 50-day moving average. I look at the 50-day moving average, percentage of stocks above the 50, and the percentage above the 200-day. And while it's not a magic formula, it will tell you the participation versus the indexes. And the reason why is because of this chart right here. Right now, we've got an amazing situation where you've got just 5 stocks in the S&P 500, and this goes for the NASDAQ too, the mega caps, are accounting for about 25% of the index, the market cap, and just 20 names are accounting for 42% of the indexes. So the indexes are being moved by just a very small handful. So there's not much breadth there. And quite frankly, when you get to the point where you're calling the FANG stocks the Magnificent Seven, that's the new name. That tells you right there that all the juice is out of the lemon. That it's like the back in the 60s, the 70s, you had the Nifty 50. You had the same thing in the 90s where you had the Qualcomms and the Dell Computers and Yahoo. They the same situation all over again. Market moving up on a smaller number of names can't sustain that. We need to broaden out.
And just jumping in here with a question, do you recommend traders also take a look at other indexes other than just the S&P 500, like the Russell, the IWO as well? Just because that gives kind of a better picture of how small and mid caps are doing, and it's not quite as dominated by these mega caps.
Yeah, yeah. I mean, you can look at equally weighted indexes. I'm looking at the 400. I'm looking at the Russell 2000, the S&P 400, the Russell 2000, and that again. Now that gets to the other point where okay, we want to know the how broad the participation, and then where the participation is.
Right.
So, I mean, just looking at the IBD 50, if you look at the IBD 50, it's near its lows, and the relative strength line is still hitting new lows. So that tells you that if you're that momentum growth investor, those stocks are not performing very well right now. You're getting it in just these very few names that are weighting the indexes, and you're not broadening out even in the narrow index like an IBD 50. But if you start looking even broader and you look into the mid caps and the small caps, they're performing horribly. I mentioned this just recently to my members that Stan Weinstein, who's a good friend of mine, and he's the one who turned me on to the trend 1, 2, 3, 4 trend stages. Just a couple of weeks ago, he was talking about a head and shoulders top, a little head and shoulders top forming in the Russell, and sure enough, we broke that neckline, and we've been coming off since.
Yeah, perfect. And when you start to notice these type of signs that the market's weakening, the leaders are breaking down a little bit, what actions are you taking in with regards to your own trading to kind of adapt to a correction? Are you sizing down more, trying to take less trades? What are you kind of doing to handle that?
Yeah, so this is really important because a lot of people they think, well, the market starts rolling over, so you start raising cash. Well, actually, even if the market's rolling over, I'm not raising cash unless my stocks are not performing well. Because you don't know when you're in a correction that you might be in a pullback in the market and all your stocks hold your stops. So there's no reason to sell unless you're starting to see deterioration in your own holdings in your own watch list. So that's really what's going to that's my lead indicator. Now, if
Mhm.
I'm seeing distribution in the market and we're seeing there's been a lot of since we topped back in July here, there's been virtually nothing but distribution days. There was like 2 accumulation days, and right after 4 days later and 6 days after the two accumulation days, we had distribution came right back. So there's no signs of accumulation. Well, now I got to look at the individual stocks and say, okay, what's going on there? And I get the two, if we get stocks aren't acting right and you're getting distribution in the market, I mean, this is just a straight Bill O'Neill
Yeah,
analysis. You're not going to get too far off track if you just stick with that. And when you're seeing accumulation, you get a follow through day. You're seeing accumulation days off the lows, and stocks are starting to set up, and you're getting stocks breaking out of bases. You're going to be you're going to not going to get too far off track being in the next uptrend. So that's really keeping it simple is the best way as far as I found. Instead of getting into I show all these indicators and stuff, but they're really secondary to the stocks themselves.
perfect. And one more question, sorry. Do you have
That's
any
okay.
do you have any goals for keeping your equity curve within a certain percentage of highs? And I know you talk a lot about the merits of selling into strength to try to keep at new highs. I know a lot of people were curious about any guidelines you have to try to do that, to sell into strength, so those corrections don't give back, all those gains that you've made during the uptrends.
So if you're selling into strength, as the stock is hitting its highest point since you've owned it, let's say, say you bought it, it goes up, you're up 10%, 15, or you're up 20% now, you sell it up 20%, you sell it into strength. Well, you're selling at the highest of your equity curve in that stock. So there's no volatility. There's no downside drawdown.
Mhm.
So if you can keep stair stepping that up, you're going to have very little volatility. Now, if you play for a much bigger move, you might have to go through some corrections, and that's going to create that volatility. And a lot of times you'll get corrections or you'll get these movements will come in bunches. So you'll get a lot of stocks will move together. And now if you get yourself fully invested, you don't sell into that strength, you play for a bigger move. Well, now you might have a good number of your names give back a lot of your gain. Then you're looking back and you're saying, oh boy, I wish I sold. I should have sold when I was up 25%. Now I'm only up 5%. Some of my stocks are stopping me out. So here's the issue, the problem, and here's the answer. The problem is that traders don't define themselves as whether they're going to be a trader or they're going to be an investor, or even going into a stock, whether I'm going into this name and I'm going to play it for a big move or I'm just playing it for a trade. And if you are going to just play it for a trade, then you have to realize that you're going to sacrifice the bigger move. And if you're playing it for a big move, you're going to sacrifice the shorter moves and you're going to have to give back. So there's a price to be paid on either side. But what happens is we get into this regret, indecision when the stock's up, and then when we make the decision and then it moves against us, now you regret it, you wish you did it differently, and now you're zigzagging all over the place emotionally, and you run into a lot of trouble because you didn't have a real plan and you're Monday morning quarterbacking. So, okay, so again, some of these things get misinterpreted, and that's why we try to put graphics and explain it as best we can. Because when you're in a correction, and in particular a bear market, you're in a bear market. Sometimes stocks are breaking out of bases and they're trying to emerge. When you just start the bear market, the first leg down, you might have some stocks that move out, but there's just not enough. Broad participation, and they pull back, and the volatility is too high, and you get whipped around. But those aren't names that you should be chalking off your list, because those are the names that are trying to get into new high ground, and then you watch them. So there's three areas when you're in a correction. There's three areas that I'm watching. One is what I call predictive. It's while the market's in correction and looking for the stocks that are trying to emerge. The other is right off the lows, when you get follow through action and you're coming off the lows. What's breaking out, what's coming out of bases, what's emerging first, what's going into new high ground off the lows. And then the final is what I call confirming. That's when you finally have troughed out in the market, you've marked up a bit, and now you start to broaden out and more stocks participate, and you start to come out of bases and it becomes more obvious. So I'll just show you what that looks like. Amgen was a name that was setting up and really held up quite well during what at the time, this bear market in 1990 was a really treacherous bear market. Percentage wise, I think it was maybe down 25-30% on the S&P or the Dow, but everybody was calling for the end of the world. As a matter of fact, this is where I met Stan Weinstein. I met him in October of 1990 at a conference. That was the first time we met and talked about the four-stage analysis, but I had already read his book. So we came off the lows here and had a follow-through day. And at that time, Amgen was coming out of this base that was really just holding up while the market was well below its 200-day moving average and well below its 50. This stock didn't even go much below the 50-day and came right back, was going into new high ground. So I bought it. I bought that stock right here. And that turned out to be a big winner. It went up about 360% over the next, I guess, year and a half or so. But if you take a look here, as the market started correcting, you can see that it was trying to go into new high ground. And the volatility from the bear market was whipping it around a bit, and maybe you would have got jostled around. But finally, it got nice and it tightened up, and the time was right once you started coming off the lows. And this is how O'Neill would apply follow through day analysis to actually buying stocks based on a follow through day. And a simple O'Neill rule is to buy something. When you get a follow through day, if big if you have stocks setting up. All right. If you get a follow through day, you don't just buy anything. You still have to have stocks coming out of bases, nice tight right sides. But if you do have it, don't be afraid that, oh, this is just a bear market rally and the news is telling me that the end of the world is coming. Trust the stocks. Go in there and buy something. Maybe you put on 5, 10, 15, 20% exposure. You take a few positions. They start working. Then you can add some more. Right here, this is where Amgen is breaking into new high ground. I'm buying Amgen right here, where everybody at this time is calling for the end of the world. This is like everybody's saying there's going to be a 1970s style bear market. This is just a brief rally here. Meanwhile, a whole bunch of stocks are breaking out of basis. I'm loading up here, and I had a huge year that year.
So, like I said, I break things down into the weekly, the daily, and the 65-minute. But at the root of all of it, and this works on every time frame. I mean, at the end of the day, this is like the 10-20 EMA. I kind of built this nomenclature for myself that helps me kind of identify where we are, as far as whether we're near the beginning of the move or if we're getting a little more extended in the move. But basically, when a stock tops out, it's typically extended from the 10-week and the 10-day, and it's got what I call an exhaustion extension. It's had a big move, and it's just kind of stretches into the stratosphere. There's typically big volume at turning points, so there's typically like a lot of volume here, a lot of chasing. Everybody's obsessed with the name. There's usually somebody very loudly talking about how it's going to the moon or something like that. And then it's like the air's let out of the balloon, and it just comes back in quickly. And it's like an exhaustion. It's like everybody who's going to buy that stock, they bought it, and there's nobody left. Stocks top when there's nobody left to buy, and they bottom when there's nobody left to sell. So there's an exhaustion. Typically, the stock will come back into the 20-period moving average. It could just be the 10-period moving average. And then it will kind of wedge up. It could happen over the course of a couple of weeks, or in some cases, maybe just a couple days, if it really kind of popped. And then it'll have what I call a wedge drop. And a wedge drop is, in reality, is what it is if you took all the moving averages away. Because at the end of the day, even though I have the moving averages here, they're just kind of like a guide. We're really trading the price bars. So think of an exhaustion, wedge up, just kind of has no power, no volume. And really it's setting a lower high, and then it breaks down off that lower high and it starts a downtrend, because now you have a lower high and a lower low. When it takes out that retest of the moving averages, it drops the moving averages, and then it has what I call an EMA crossback. What's an EMA crossback? Stock moves down, it has its expansion to the downside. So that's really all I'm doing, is playing expansions, and then it kind of contracts, it wedges back up into the moving average, and then the sellers come back after it and they sell it back down. And then, we have what I call a basin break, which same deal. It's just like a consolidation. And then the sellers come back in, they sell it down. But now the opposite of the exhaustion is just, you've got this fear, everybody's selling out of it. The guy who said it was going to the moon at the top and wouldn't admit he was wrong, now he's kind of walking on eggshells, and they capitulate. So I call it a reversal extension, but it's really just a capitulation extension to the downside. And why is it capitulation? Because everybody who was there who wanted to sell the stock, they hit out. And maybe you get some undisciplined shorts who say, oh, I should have shorted this up higher when I knew it was a short. I'm going to do it now. I used to trade for big hedge funds. That happens a lot of the time. And then is what ends up happening is the opposite of an exhaustion extension. It kind of reverts, a reversal, it reverses back, and it comes up into the moving averages. Typically the 20 EMA. There's a lot of volatility. It might get rejected from the 20 EMA and look like it's going to turn into a bear flag. A lot of the time, that's actually when I get bearish, is right around then when it's going to put in its higher low. But then it kind of contracts its vol and it tightens up a little bit, and it builds. What does it build? It builds a higher low. Right? So stocks top out when they have a lower high, and they bottom out when they have a higher low. That volatility contracts, and then you have what I call a wedge pop, which is just like a move back up through the moving averages. But again, it's just like we built a higher low, and now we're going to turn the trend back up. We expand higher, we contract via some tight sideways action. It supports at the moving averages, but really it's like supporting at the moving averages. Just know it's building its next higher low. And it just so happens a lot of the time, not all the time, but these moving averages, they do a pretty good job of tracking those higher lows. And then we expand higher, and hopefully we have an explosion higher, and then we build a new kind of maybe 2 to 3 week base or so, a base and break. We break higher, a real good trend, an intermediate term trend, something in the kind of 4 to 10 week range, will hopefully have like 2 base and breaks. And then you kind of do it all over again. The euphoria sets in, the stock goes parabolic, and it kind of bursts. And so typically you want to try to do your buying around the wedge pop, which is the ideal buy area, or around the EMA crossback, that kind of first higher low. The reason being for that is that the time period between the reversal extension and the wedge pop, there's typically a lot of volatility. And so there are times where I've picked the low in the stock, the reversal extension, I knew it was capitulation, and it ripped up, and I did really well, and I should have just taken my profit, because then it started to set up like a bear flag and it looked like it wanted to break, and I would get scared and sell, and I'd make maybe 30% of what I should have made. But then all it does is kind of put in that higher low, contract. And then when it has a wedge pop is when you kind of get that more trending type move versus that huge, reversion, tons of vol. So we want to try to trade the low volatile, kind of trending part of the move, and then kind of step aside, at the major turning points. And so another key here is you want to try to identify stocks that are in their weekly upcycle, which can last, years. You could have like an 18-month upcycle. And then when you have a daily down cycle within a weekly upcycle, meaning you're below the 10-20 day moving averages, but you're still above the 10-20 week moving averages, a lot of the time that down cycle will be very compressed and choppy. It won't be like a massive move down. It'll just be a stock that got too extended and needed to kind of reset up, rebase, get back into the 10-20 week or the 50 day. The 50 day about lines up with the 10 week. And then you want to try to get on to situations where both cycles are aligned. And is what I mean by that is we're in a weekly upcycle. We want to try to play the daily upcycle and then get out of the way for the daily down cycle, because it can just be choppy, not massive gains. Now, if you're really good, like I know some people are really good at shorting those exhaustions. It's not my number one thing. I'm pretty good at selling them, but I'm not the best at shorting them. That can be actually a really, really the kind of quick trade, but then the actual move back down can kind of, it's just like you're better look, if you're good at it and you're good at, kind of fading the weekly move, then have at it. But I find it's best to align the weekly and the daily. I'll just kind of leave it at that. But that is what I'm, trying to do, at the core of it all. And the way I go about that is by combining the weekly, daily, and 65-minute chart.
To kick things off, though, David, I just kind of want to set the scene here. And I'd love to hear your take on the current bear market that we're experiencing and how you've dealt with it. We last talked and did an interview back in fall of 2021, and I think you had some cautionary words back then. So I'd love to hear how you've dealt with it and what were the signs that you were noticing that we could potentially be entering a correction. Obviously, we never know how bad it's going to get, but what were the signs that you were kind of looking at?
Well, the signs were a lot of great stocks actually topped back in February of last year, and a lot of growth stocks did. But the market, there was so much money in the market, and the government was dishing out so much money that that it just kept on rotating into other groups, and then with so much money in the economy, prices started moving up. So commodities started moving up, oil and gas started moving up. So a lot of growth ended in February of last year. I mean, if you just looking, at Zoom video on that we're using, this was actually in the fall of 2020,
Yeah.
long before the market was topping out. But a lot of other things started topping in February. Here's Shopify. Well, I guess Shopify actually went a little bit. It went until November, December, but really you didn't make much progress from the high in February of 21. So I saw that going on, and we kept on rotating into different groups, and all the cyclicals were moving, and fertilizer stocks were still in a great uptrend up until March of this year. But then you did get the indexes starting to top out in January and February. So here's really the beginning of the year, and then I mean, you can start seeing. Look at the volume starting to pick up on the downside. How many days in a row you had as the market was topping? Look at all these volume spikes are coming in on the downside up in here, and then you start breaking moving averages. And look, in the rallies started getting lighter on lighter volume every time you rallied. Even through this great rally from 420 to 460, which lasted only 3 weeks, the volume, you had one day above average daily volume. And then the volume started picking up again onto the downside, and you get huge spikes down. And so you're really in a series of, it's a downtrend where you get 2 to 3 week rallies, and the rallies come on weak volume. Even yesterday, you look at the spiders, it had a great day, but the volume wasn't even bigger. I mean, yesterday was kind of Thursday was a stalling day, but yesterday you still had lighter volume. Now you can play these rallies if depending on your time frame. If you have a very short term frame, you could try to play these rallies. But and I actually started buying a few things down here for just a trade that maybe will last a few days into the 50-day moving average, or maybe it goes a little bit longer because so many people are negative. But until these moving averages start trending back up, you have to treat everything with a lot of caution.
Perfect. And there's a great question here from Roy, asking about your experience as a hedge fund manager. So, David, when you ran the hedge fund for 15 years, did you ever go through periods where you were 100% in cash during bear markets, for instance, in 2000, 2002, and 2007, 2009?
Yeah, absolutely. Because when I ran my hedge fund, if you look at the monthly, I'll show you where I started. I think I started in, this is a monthly, and so I started right here. Markets sold off into the fall, and then had one final move up into a high, but then corrected 50% and another 50% twice while I was running the hedge fund. I ran it until about this period, 2014, but I went through 250% corrections, but I lost very, very little because I went to cash. And that's so what's great about operating with a discipline is, if the discipline should get you in as the market is turning and stocks are starting to show up with the right characteristics, and it should also get you out when the market is rolling over and there's nothing left to buy. And so during these periods, I was 90% cash, maybe 95% cash. I had very, very little in the marketplace. And my clients loved me because they would see, I think in 2000 and maybe it was 2007, 2008, I think I might have been down like 5 or 6% for the year, while they look at their other portfolios and they're down 30 or 40%. But I see no reason. There are times where you should be 100% out of the market. On IBD Live, I said, especially for people who are new to this, this is a great time to study and to just sit on your hands, because the opportunities are so small. Your chances of making money, making a lot of progress, are very, very small.
Perfect. And David, I know you said you keep things really simple and just look pretty much at the market and leading stocks, but do you look at any kind of indicators like the advanced decline line that gives you a sense of, the market breadth, or the percentage of stocks above the 200-day moving average, stuff like that? Or it's really just the indexes and the individual stocks themselves?
Yeah, I look at indicators. I've got some indicators that I look at on stock share. I've been actually keeping the McClellan oscillator. Well, I actually don't do it by hand, but I used to do it by hand. The McClellan oscillator and summation index, which really is just a moving average on advances versus declines.
Right.
And I've been watching that since the early 80s. And I look at that, but a lot of a lot of those are just kind of secondary indicators where, yes, I put value into it, but most of what I get is just looking at price volume on the indexes and the individual stocks.
Perfect. And I know a lot of your presentation was about how the same patterns repeat themselves and things never really change. But has kind of the pace of things in the market gotten a little bit faster over the years? What are your thoughts on that?
Maybe the intraday moves are faster, but it seems like if you step back, the move still, a stock usually has a nice move over a year and a half to 2 years. Bull markets last longer, let's say 2 or 3 years before you get a major correction. They I would see maybe just more the intraday movements are faster than they have been in the past, and maybe that's because also a lot of stocks trade at much higher prices than they did in the past. In the 80s and 90s, there was very few stocks that traded above $100 a share. Most everything was below that, and most stocks split when they got too high. Now, very few stocks split. I mean, I guess more have been recently. Um, but yeah, so I think the movement, at least maybe on a price basis, is a little faster intraday, but not overall.
Perfect. And there was a question, I can't find exactly who asked it, but it was basically, have you noticed any kind of differences in the success rate in buying breakouts, now versus back in the past, back in the 80s, 90s? Or is it really about, there's a right time, a right environment to be buying breakouts? And a lot of the times, when we're in a correction like this, they're not going to have, great success rates.
Yeah, in a market like this, I mean, the amount of stocks that break out and have a great move are very, very small. I mean, and in a market like this, if you're going to trade them, it's much better to be buying weakness as it's starting to turn than it is to buy a strength of a stock that has already come up, is already up 20% from its low and now breaking out. Um, but yeah, no, they'll work a lot better when you're in an uptrend, and when things start turning, a lot more will start breaking out and going. But this is not that environment right now, and we might be in this environment for a while longer until inflation cools off and rates have gone up. Um, yeah, and then one other thing on indicators and stuff, I know a lot of people, they look for the follow through day that O'Neill has written about. And when you get in a market like this, a lot of those through days don't work. And I don't put that much. I say, I look at the follow through day, but I put so much emphasis on, can I find the individual stocks to buy? And if I see the market following through, but I look around and there are no setups, then I go, how far is this really going to go if I can't find individual stocks? So uh, you have to combine the two and get the whole picture of what's happening.
So in early 2000, you can see on the NASDAQ, we had the double top, and stocks had a tremendous move. And from 1998 to 2000, we had what was known as the internet bubble. You had dozens and dozens and dozens and dozens of stocks that went straight up, that blew off, that had no earnings. Just anything that was associated with .com went up. Companies were changing their names and adding .com, pet.com. They were adding a .com to the end of their corporate name. And any of those companies that did that, the stocks just took off. And so it was a bubble, and it was a feeding frenzy. And in fact, at this particular time, we had just had 5 years of 20% returns. And just to show you how bullish the sentiment was and how excessive it was, everyone that you did, that you conducted surveys with during that time expected another 5 years of 20% returns. And so anytime it gets that good for that period of time, you can understand that we're going through just an irrational period of time, and that's not going to last. The market is going to revert back to the mean, and the mean is, the market is averaged 8-9% for the last 80 years, on average, despite 14 to 16% pullbacks that you can be assured of that you'll get once a year. So here, the bear market lasted from 2000 to 2002, and we'll take a look from that March 2003 day, because we are utilizing these patterns and to look at currently to see, well, how does this compare to the 2003 turn and also the 2009 turn? So that's important information for you to look at. So this is the first half of the year in early 2000. You can see the downtrend. And so again, with that double top, you would have been kicked out of the leading stocks by the time the downtrend was in force. But again, you didn't, in this particular case, the NASDAQ dropped from 55,000 to 4,500 before before it triggered. And so, you're not going to, because you're trend following, it's going to be a lagging indicator. When you look at trend, you're not going to get it out exactly at the day of the high, but you can see that you got out within 5% of the high. And here you can see the market then was in this downtrend. And notice, you can see when you're in a downtrend, you can have brief 2 to 3 day rallies, but if you're trying to trade those, you must sell those. It's very, very difficult to trade, in particular your entire portfolio, for 3 or 4 reflex days, rallies in a bear market. It's psychologically defeating, and it's fatiguing, and it's exhausting as well. That's why we think it's important to just avoid these downtrends and just participate in the uptrends, as much as reasonably feasible. So you can see here the uptrend took place, months, a few months later. You avoided all the carnage that took place from that downtrend to the market bottom. Boy, this was amazing, and this was amazing. Obviously, this was the COVID crash of 2020. And notice in this particular case, see, you had the break of the 50-day on volume. Notice, and this is, Wes, will you illustrate that on the chart there in February of 2020 over there? Thank you. So you can see the 50-day, the break, and there's your exit point to get out right there on the break of the 50-day. And then the trend followed a couple of days later. And this was the most brutal and the quickest bear market that we've ever experienced, over the last 4 decades, in my view, where you were down 35% in a month, in 4 to 8 weeks, and you recovered the entire move, in the next, 8 weeks. It's very, very, very rare to ever experience something like this. And this is when the news headlines, of course, at the bottom was as bearish as I've ever seen it in my career. And so we had the follow through day, you can see after the bottom, and then the market went into an uptrend after that. And, if you're not looking at these tools and you're licking your wounds, and if you got out and it's okay to get out, but you have to know when to get back in, and when are you forced and to get back in? When are you forced? You're forced when the trend changes. Now, in reality, as you study and you go back and you look during all these time frames, go back and look at who were the biggest stocks during that, during the bull markets. And you can see that many of them, you don't know in the bull market the new bull market, who they're going to be. So in many cases, it is easier to just buy the indexes like the NASDAQ or the S&P when you have, when the trend first changes. So it's okay to get market exposure if you're not following individual stocks, or you don't know who those leaders are. Sometimes it doesn't happen simultaneously when the market bottoms. You don't have stocks that break out to brand new highs. They typically happen over the next 4 to 6 weeks after the lows take place. So there's an incubation period where the setups take a little time to present themselves. And, so it's interesting. Go back in 2020, for example, and look at the Tesla bottom when the market bottomed here on 2020. Look at Tesla, look at Shopify, and go back and look at some of these stocks, and you can see where they looked on the charts. They weren't at new highs at that particular time, but they were setting up to launch themselves to make a major move over the next 2 to 3 years.
That transition from cash to when we're in a new uptrend, how do you guys go about it? How quickly do you guys look to go back to close to fully invested, or how much you guys want to be invested, and what kind of things you look at in terms of if you have any rules about, hey, I can't change my exposure levels more than 20% in a day or something like that?
Now, what we did was we ended up selling and taking a lot of profit in selling. We sold half of a lot of our winners. We incrementally moved out.
Right.
And what we did was the stocks that we sold, and we sold stocks like DraftKings and Uber and other stocks. We sold them correctly, and then we bought them back as they came in, but they didn't hold. And so we found that on the pullback, we were buying on the pullback, and they didn't hold, and we got kicked out because we had probably 5 to 8% losses in them. And then we had to pivot and determine, well, who are going to be the new leaders in the uptrend. Normally, the stocks that were leading the uptrend, they're going to, in a pullback like this, it's going to be the same leadership, but you just need time for those leaders to breathe and set up for 2 and 3 week type patterns. For example, like right now, we had this market that made a new high on Friday, and you had potentially a key reversal day. You opened strong, closed weak. What does that suggest? Well, Wes is going to take a look at on the next slide about MACD and a couple of things. And we're not getting into using tools a lot, in terms of dialing down into the specifics, in terms of looking and pulling that up right now. But you can see that the momentum is somewhat waning, just a degree. But we think this is setting the stage to pause for semis. And we think that, that semis aren't necessarily over, but they're breathing and they're going to pause here. While other groups like software is coming back into favor, and some other stocks are rotating. Again, small caps and mid caps were up on Friday, and we think a potential rotation may be taking place there. But we waited for that for the last 2 years, right, for that quote rotation to take place. But until large cap, mega cap stocks are going to lead until they don't. But it is important to watch them right now to see, well, do they have another leg up to go? Are they going to participate in this AI bonanza, or is it over? We think that there, by no means is this over. We think that you're just getting started in AI and the ramifications of indoctrinating AI through our whole society. Mm-hmm. And we think that's going to lead to great productivity, higher prices in the market, higher valuations, better earnings, and a better market environment for the second half of the year, fueled by also the seasonality of the presidential election year and other things.
Yep. And well, Richard, I was just going to mention something about that question. I think you said you put on the Qs, made the TQQQ. I think we do the same thing a lot of times, especially on a follow through day when everything's kind of beaten down, and because of follow through day, right, coming off of the low, there aren't a lot of stocks, of course, going to new highs. So we find that definitely index exposure is just a good way to get that exposure. I think on this day too, where we broke above the 50-day, I think Nvidia was probably breaking above the 50-day. I think we were looking for a number of those to kind of, not necessarily be at new highs, but the leading stocks would recover their 50 days first. So that was I think that was probably those were a couple of actions I bet we took that day. And then you see when the short-term trend change right there over the next 5 days, it did give you a lot of time
Yeah.
to see things, and you can see the market was consolidating and having this sort of short handle, shallow handle. I'm sure a lot of stocks were doing the same thing, but I would say we're not going from 0 to 100% either exposure in a day. It's certainly going to be more measured. I bet 30% changes would be like the
Drastic.
most we would do
Yeah.
in a day. Maybe going from 0 to 30% could be reasonable for us.